Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Sofi Technologies SOFI stock and Palantir Technologies PLTR stock. We're going to start off the video by talking about the latest stock news updates for both of these companies, and then we're going to dive into them deeper by giving you some price targets and price predictions to determine if these companies are still great companies that we should be invested into. We're going to start off talking about our first article, which revolves around how somehow Sofi Technologies could be responsible for a giant market crash, according to the comptroller of the currency, Michael Shu. Then we're going to move on to Palantir Technologies and go over the bearish and bullish views, which are the negative and positive views regarding this particular stock, and how many investors as well as analysts believe the stock is actually undervalued right now. So we're going to do a fair price estimate to determine how much Palantir as well as Sofi Technologies could actually be. For more videos on Sofi Technologies and Palantir Technologies, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, become a member of this channel if you want a fun way to support me, and without further ado, let's jump right into today's stories. Right now, we're going to focus on Sofi Technologies, because according to analysts, it is a bargain to buy Sofi Technologies along with many other stocks that have fallen recently, and this particular article highlights 3 bargain stocks to buy and hold right now. Now, we're not going to go into detail into all 3 of these companies. We are just going to focus on Sofi Technologies. However, the article does highlight Home Depot along with Kinder Morgan. But for this video, we are just going to talk about Sofi Technologies. So why did this author pick Sofi Technologies as a company to buy based off of its recent weakness? Well, he says that the Sofi stock price has fallen at nearly 2/3 of its value since the start of the year. And he says that the fintech sector has been extremely hot as of late, but more recently it has cooled off considerably, which means that long-term investors who are looking for a bargain or stocks that are potentially undervalued could jump into this company to make a decent profit. But why does he think that? Well, the main reason for that is the current stock price is only around $5.92, while professionals believe the company's worth anywhere between $7 on the low end and $11 on the high end. And since I'm very bullish on this company, I would more gravitate toward a $10 price target for this particular stock, which means you could almost double your money in the span of just 12 months. This also begs the question, why is the stock trading so cheaply and could it continue to fall? Well, first I want to say yes, the stock price can definitely continue to fall because of the negative macroeconomic environment considering the economy as a whole. This would include fears of CPI data, which is the consumer price index, which measures inflation. So as inflation increases, growth companies and technology companies like Sofi Technologies are going to be hit very hard, particularly because of the debt that Sofi has on their balance sheet. Another problem is that investors are very fearful of an economic slowdown and or downturn, which could cause a market crash or other untimely phenomenons for their overall investment strategies. And that's why Sofi Technologies is trading rather low. However, what I do like about Sofi Technologies is that if you look into the financial statements of their balance sheet, their cash flow statement, and their income statement, you can see that fundamentally as a business, Sofi is very well positioned to even grow during economic uncertainty, even if the overall macroeconomic environment continues to trend downward. Now, the stock price, like I said earlier, can continue to trend downward, but this just means that the stock price is not reflecting their actual company fundamentals. So overall, this is still a solid company fundamentally. I also want to say that the company continues to expand and grow their overall offerings as well as their overall revenues, because Sofi Technologies, if you didn't know, is truly a one-stop shop when it comes to financial services and financial products. They are basically operating as a digital bank where you can get anything you could possibly need in terms of financial services and or financial products. This would include various types of loans, refinancing, as well as many other products such as checking accounts, savings accounts, credit cards, debit cards, and a brokerage service. where you can buy and sell stocks as well as cryptocurrencies. I also want to mention how the company is continuously expanding their financial products and services that they are offering their consumer. And as SoFi continues to increase and bring in more consumers and customers, their cross-selling myriad and their cross-selling business model is just going to make more and more money off of these people, while also helping them, because SoFi does have fantastic financial products and services in my personal opinion. Now, I do want to mention that the company is not a profitable company, but the good news is that the company has grown their overall non-GAAP adjusted net revenues by around 50% year over year, which is absolutely insane. And this actually beat the projections and forecasts that analysts estimated. So clearly this company is becoming very bullish, and their overall financials are showing that. The growth train for SoFi, in my opinion, is just getting started, with the company potentially becoming profitable in 2024, while other financial reporters believe the company could actually become profitable in 2023. Now, if we take management's guidance for their overall growth, I think that the company achieving profitability in 2024 is definitely the safer option, and I also want to say that their management anticipates similar growth throughout the first half that they are going to bring in during the second half, which is overall very positive. But now let's focus on some of the negatives, like how SoFi could possibly be responsible for a giant market crash, according to the comptroller of the currency, Michael Shu. So let's dive into this article and find out. Essentially, Shu believes that the popularity of fintech companies and how they operate and work with digital banks or regular legacy banks could warrant financial risks over the long term for the overall economy. He later adds some context to this statement that says that there is a severe problem or even a crisis that is going on right now due to fintech companies, which would include SoFi Technologies. The article goes on and explains that in recent years, banking and technology companies have teamed up to provide various services for consumers, which overall to me is a win. That's good that they are offering more products and better services to customers who need financial products or services. However, as a result, it's harder on regulators to differentiate, and it's making it more difficult for them to distinguish between a banking company and a technology company. So this actually involves the legality of what these companies can do and what they can't do based upon the sector, space, or industry that they are in. This is why Shu believes that this kind of phenomenon of various companies teaming up together could create some legal risks and some problems, which could cause some of these companies getting away with some shady works in terms of their financial products or services, or how they are treating customers. Michael Shu goes on to explain, and remember, this is a very educated individual who is a comptroller of the currency, where he says, and I quote, "I worry increasingly about the unknowns and am concerned that the less familiar risks of this digital transition are unlabeled and thus unseen. As we learned from the 2008 financial crisis, risks that are unseen have a tendency to grow and later to be a source of nasty surprises," end quote. Now, for me personally, I think these comments are blown completely out of proportion, and I really don't get to see the overall fear in regards to this, because even though, yes, fintech companies are operating like banks and teaming up with banks, the banks are still their own entities and still regulate the economy very efficiently, and those laws and the legality involving these banks are still active, even if they are being helped out by another fintech or technology company. So I really don't see the big problem here, and I understand how digitalization increases, this is going to cause some problems, but that just means we need to make more laws and other guidelines that can clear up any ambiguity. But I don't see this at all causing a market crash like we saw back in 2008, which he referenced. Now, with that being said, that's just my opinion. The article author goes on to quote another former comptroller of the currency, who is Jean Ludwig, who believes that fintech companies could create financial risks as well. So both the former comptroller of the currency and the current comptroller of the currency both say that that this is a very large risk. He goes on to warn that non-banking companies will, quote unquote, get us into the next financial crisis if we don't do something about it. So honestly, I do understand that there is risk here, but I still think it's being blown out of proportion as long as our laws and legality and policies keep up with this innovative environment. Now, I also like how at the very end of the article, the author highlights that SoFi alone or SoFi as an individual company does not hold the power to cripple the entire US financial services system, because that would just be absolutely insane. In this particular article, they're talking about all finance or fintech companies, not just SoFi Technologies. But overall, I would say we have very good price targets for SoFi with the potential of close to doubling our money over the span of just 12 months. But what do we think about Palantir Technologies? Where has that gone? Well, Palantir Technologies, if you didn't know, is a big data and analytics company that serves both commercial clients as well as government enterprises. And right now it trades at $7.49, while professionals believe the company is worth anywhere from $6 at minimum and $20 at maximum over the next year. Now, this particular author has a hold rating for the PLTR stock. Now, I personally really like to read articles that have hold ratings because this means we're going to get somewhat of an unbiased picture of this overall company. And he even lays this out because he says if we put this company on a spectrum, at one edge of the spectrum, we see cynics and critics of this company that don't take this company seriously. They say that Palantir is a meme stock and that their PLTR stock is basically worthless. And then at the other end of the spectrum, we have a cult-like following of a bunch of loyalists who are not swayed by anything the company does wrong because they believe that Palantir is going to be the next Google or Apple of some sort in terms of data processing and their data technology, which they believe makes Palantir a market leader and at the forefront of the overall industry. And for me, I like to take more of a middle approach by just focusing on the numbers. What do the financials say about this particular company? Well, I would like to first point out the bearish view of Palantir Technologies by highlighting what's happening in their government segment. So Palantir mainly focuses right now on their government segment. However, I have predicted over 2 years ago that Palantir will start to focus more on their commercial clients, and eventually the amount of revenue that they bring in from their commercial clients will surpass the amount of revenue that they are gaining from their government segment. But the bearish view of this just focuses on the government segment to say that Palantir's government revenue, at least on an annual basis, is falling very rapidly. And this chart on screen outlays that completely. So clearly from this chart, we can see that Palantir's government revenue, at least on an annual basis, or at least a quarterly basis, is downtrending very aggressively. However, this could always change because as Palantir continues to bring in more clients both domestically and abroad, this is going to help their overall government contracts and their government clients, because they serve the US as well as US allies. And as the US continues to use Palantir, that is going to at least show the allies how important and secure and aggressive Palantir can actually be. Now let's move on to another bearish comment that we see from Palantir naysayers, where they say that their sell-side analysts are very high, to where only 28% of analysts who cover the company say that this company is a buy. Now, in my personal estimates of the analysts that I looked at, I actually calculated around a 31% amount of analysts that say to buy the company, but 28's already really close to 31, so I could easily let that slide. However, this does not mean that Palantir is a bad company. It could just mean that analysts aren't overly bullish on this company at this time, because of course analysts could always change their price targets, their predictions, and what they think of the company, or their price targets. They do this all the time. They flip and flop, which is why we should only take their considerations with a grain of salt or as a guide and not as what's actually going to happen or what the stock could actually be worth. Lastly, he does have a good point here where he says that Palantir's ownership by institutions has been declining, which is 100% true, and that is a very bearish look and a negative look on this company, which is not good. We would want them to have very strong institutional backing. But now let's look at the positive side. Well, the positive side is that A, Palantir, especially if we look at their fundamentals, is fantastic. They're set to bring in fantastic free cash flow. They're trading at a average or even a competitive PS multiple compared to their competition, and they have a very strong balance sheet. So what do I mean by a strong balance sheet? It means that they are in a good place to where even if the economy completely crashes, Palantir is going to survive due to the amount of cash equivalents, and liquidity that they have on their balance sheet, which numbers close to $2.5 billion, which is very unusual for a growth company to have this much liquidity on their balance sheet. Palantir is also working to optimize its overall workforce. Now, this is where I'm actually going to disagree with the author on this particular point, because he says if he compares Palantir to 5 of its peers, that Palantir is using their human capital more effectively. And he does this by saying that per each employee that Palantir has, one employee alone derives or generates around $500,000 worth of sales. So this is where you just divide their overall revenues by their amount of employees. However, I think this gives us a very skewed view, because clearly companies with lower amounts of employees, even if they have less revenue, it's going to reflect very positively. This doesn't mean, on the other hand, that if Palantir were to hire more employees, that somehow that they wouldn't generate the same amount of revenue, or rather more revenue. So I think this is somewhat of a moot point, because this would actually argue against Palantir expanding their overall workforce, and I personally think that Palantir should expand their overall workforce so they can continuously bring in and generate better products and attract better customers, especially if they start to leverage their expertise in terms of a very deep sales force or hire more sales employees than they already have. So that would be my thought on that particular statement. As far as business growth goes, I called probably a year ago that Palantir Technologies will not be able to sustain their 30% CAGR or compounding annual growth rate for the year of 2022, and as of right now, or according to Y Charts, I am going to be right, where they believe the company is going to bring in a growth rate for their revenues of around 23 to 25%, and I personally said 25%, even though the management of Palantir said they were supposed to bring in a 30% growth in their revenues from now until 2025. So that is somewhat very negative. However, 25% is still very good, even though clearly it's not as high as what the company was originally forecasted. And that, I just think, is due to the negative macroeconomic cycle that we are in right now. But eventually, I do believe the market will become bullish again, which is going to inflate their overall growth rate, and hopefully that reflects very positively in their overall stock price. But this is the part of the video where I really wanted to get into, where an author says that the company is undervalued and that it's oversold right now if we look at their price to sales ratio and their price to free cash flow compared to its competition. Now, in the previous Palantir video, if you remember, I actually compared Palantir's PS ratio and many other accounting ratios to their competition. So I am somewhat in agreement with this author, but we'll have to just take it one step at a time. The author also highlights how the leadership of Palantir is estimated that the company will become profitable or reach profitability in 2025. However, he argues that Palantir could be profitable much sooner if government revenue increases and gains its growth rate back, or if they stop stock-based compensation. And I've already said this in multiple videos, that if they stop stock-based compensation right now, the company literally could become profitable overnight, but I don't see that happening, because they are using their stock-based compensation to attract the best of the best engineers in the industry, which I personally think is a great long-term plan. Lastly, the author says the company is undervalued if we use a discounted cash flow model, and I actually agree with him. I have personally ran these numbers and made videos on how I calculate fair value prices, and I use a DCF model, or a discounted cash flow model, to estimate a fair value price. However, there are assumptions in this model to where the price target or the fair value could fluctuate anywhere from $15 to around $20 to $30 per share, and this particular DCF fair value estimate comes in at $25.23, according to this DCF model, with the assumptions that the author actually built into the model according to Simply Wall Street. But I would love to hear if you all think if Palantir is truly worth $25.23, and tell me your thoughts down below on where you think the Sofi stock is headed and how high that could surge in the next 12 months. But with that being said, remember to comment your thoughts down below, subscribe if you're new, smash that like button if you haven't already, or if you want more videos like this one, and I will see you in the next YT video.